Okay, good afternoon to you all. Can you all see the presentation? And am I audible?
Yes, sir. Can see, can hear.
All right, thanks. Last discussion, we couldn't have it. So from the last discussion, we stopped somewhere like here, banking, and you have to start from banking and the management of financial institutions. So up to now, is there any question? In this chapter, we discuss the financial structure throughout the world and how important are the bank loans. And then we discuss adverse selection and moral hazard and the solutions for that, right? And it's basically the base of this discussion was like the facts we discussed, the 8 facts, right, about the financial system, right, based on the structures. Okay, if you're clear on that, we can move on to the banking and the management of financial institutions. So in our syllabus, we have seen what is financial system all about, and we had the interest rate analysis, and we are discussing now financial institutions. Under financial institution, the existence of financial institutions, why the financial institutions are more important, we discuss. And throughout the world, like throughout the around the world, so you could see the loans are key financial source of finance we could see. Then today we are going to discuss about, as I said, overall banking and what are the salient features in managing financial institutions. And then we would be covering the regulations in Sri Lanka as well in a summary versions. If you need any further clarifications, we can discuss in detail. Okay, now if you can see a bank balance sheet, right? So in a bank balance sheet, you could see like liabilities and assets. When it comes to liabilities, you could see checkable deposits. That means current account and non-transaction deposits other than current account deposits we could think of, and then borrowings, bank capital, right? These are the key items in the liabilities. And if you take assets, the first one is reserves, and second, cash items in process of collections, and deposits at other banks, securities or maybe investments, and loans and other assets. So if you take a balance sheet, these are the major items in a bank's balance sheet you could see, right? Whatever happens, like any transactions, if you go through, there will be a changes in this balance sheet position, right? Okay, so let's see, this is extracted from the book, right? Based on US financial systems. So table 1, it shows balance sheet of all commercial banks, right? Items as a percentage of total June 2017. Now you could see, right, I have given in a table because of the size, like you could see it's a continuation of second one, first continued by second one, right? Okay, now if you see the first item, reserves and cash items, that's 14% of the total assets. And If you take securities, that's the US government securities, state and local government and other securities, it's 15 plus 6%. And then if you take loans, there can be commercial loans 13%, real estate 26%, and consumer loan 8%, interbank 1%, other 9%, and other assets, basically physical assets. So it's 8%. This is the overall balance sheet, the accumulated balance sheet of or aggregated balance sheet of US financial system. And also, if you see the liabilities, first one is checkable deposits, 11%, and then other deposits and other non-transaction deposits. You could see like saving deposits, small denomination time deposits, and large denomination time deposits. So if you take all together, saving deposits are very high, 50% of total assets, or you can say total liabilities as well, right? And then borrowing 17%, bank capital 11%. Okay, now you know like basically how a bank looks like in US, right? You can compare this pattern with Sri Lankan banks and see how our regulations are differs based on this structure. If anybody likes, give me a hint in what order these items are listed in this balance sheet. So silent, Rajakarna.
In the way, in the form of liquidity, sir, the least liquid assets to the most liquid assets.
Exactly. So top to bottom, you could see most liquid assets. So then bottom is least liquid assets. So bank capital, it's 11%. Normally, you could see or you can remember like in US financial system, the regulatory requirement is 7% or 8%. So they are maintaining bank capital is 11%, but our one is higher. So we always like 12 to 15% our capital range, uh, right? Okay, so this is basically a major items in a balance sheet. You might be able to understand, right? Okay, now what we are going to look into that is like basic banking, right? So always please understand when you like think of transactions, what would be the entries, a kind of a T account you can think of. Then you know like how this mixture of assets and liabilities changes. What will be the final impact based on these transactions. Okay, first we assume a customer is going to have a cash deposits, right? Okay. Uh, when you think of cash deposits, what would be the double entry? Or what will happen to the assets and liabilities of a bank? Can anybody? You all have the presentation with you all, right?
No, sir, this wasn't uploaded to the classroom.
Oh, but I checked this at like uploaded. Just have a look.
It
Okay.
it was just uploaded, I guess, today.
Okay. Okay. I checked like maybe this morning. Okay, just have a look. Okay, so now if anyone can tell me, okay, if a customer doing a cash deposits, what would be the changes um, in the assets and liabilities of a bank? Come on. No, like you are a bank, like it's very important to understand this one, so then only we can understand the monetary policy, right? So you should be able to, explain what would happen uh, in terms of cash deposits in the balance sheet of a bank, right? Um, okay, you see the first part, right? So customer is coming, right? And make a deposits, cash deposits, right? So then his current account, right? Okay, credited. It's $100, right? And then the bank get the cash. So assets increases, it's a vault cash. Is that clear? You have to tell me whether it's clear or not. Gavin, is that okay?
Yes, it's clear.
Okay, okay. Yeah, so then what will happen is like, okay, you have a deposits, right? It's $100 worth of deposits. So then, as per the regulatory requirement, okay, central bank requirements, you have to maintain a reserve equal to that, right? Let's assume it's 100%, right? So what will happen is, right, you have to now, right, keep it in central bank account, right? So then we call it as a reserve. So in this First National Bank, we have given a name called First National Bank. Now if you take the balance sheet, now liability side, you have these customers deposits, it's 100, and then asset sides, it's a reserves, right? You just think of our statutory reserve requirement, SRR, right? That percentage may be vary, right? For time being, you think, right? So this is the requirement, so they park there, right? The money parked in the reserve account. So asset sides, you have reserve, and liability side, checkable deposits, right? This is in terms of cash deposits, right? Okay. Now let's see if a customer is having check deposits. So if they are going to have a check deposits in your checkable deposits account, so what will happen, right? So you always, right, you credit the customer's deposit account, but you are going to debit not under cash or vault cash. It's a cash items in process of collections because it's check, right? So then automatically that will go to clearing. So then your reserve account would be debited, right? So that means your assets, right? Central bank point of view, that's credited, but your point of view, the banker's point of view, that's reserve. So here there are two things. First, you debit and cash items in process of collections. So finally, your accounts, maybe two accounts, that is checkable deposits 100 and reserve 100. So when it comes to check deposits, I hope that's clear, right? Okay. So similarly, I don't need to tell you all again. So similarly, so when somebody is withdrawing their deposits, it's vice versa, right? So you will lose deposits as well as you will lose reserves as well, right? Okay. So how banks make a profit, right? Now the question is, okay, so you have the deposits. So in your liability side, you have deposits, and asset sides, you have reserves, right? So how these banks are making profit out of that? The business coming from the requirement of reserves. Now let's assume you see the first table, right? Checkable deposits 100 under liabilities, right? But now the reserve requirement of central bank is only 10%. Earlier, when I discussed it, I said, okay, assume 100%. Whatever the deposits comes in, that goes, accounted as reserves, right? 100%. Now let's assume your required reserve is only 10. In the first table, you can see that now excess reserve, then how much? 90. So earlier we thought 100 goes to the reserve account. So 100 you have. So out of that 100, the required reserve accounted for 10, and you have additional 90 bucks in addition to the required reserve. Now you can use that. What the banks are going to do? They can lend, right? They can provide loans. If they are going to give the loans, now if you see the First National Bank's balance sheet now, liability side, okay, $100 deposits, but asset side, you could see required reserve is $10 and then loans $90. This is what we call asset transformation. Selling liabilities one set of characteristic, selling liabilities with one set of characteristic, and using the proceed to buy assets with a different set of characteristics. So you are going to play around with that. Maybe if in a simple term, okay, you get a deposit at lower cost and give the loan at a higher interest rate, you make a profit. That means bank borrow short and then long. So this is the asset transformation. So if central bank wants to have 100% as a reserve, you cannot make any loans. But when central bank says 10%, you can lend 90% of your deposits. So this is the basic business, right? So how much you can lend, it's based on the reserve requirement. We call it in Sri Lanka SRR, statutory reserve requirement. Is that okay? Right. I hope that's clear. So next one. So this is the banking, right? but banking subject to serious, risks. So you have to manage those risks. So now question is, what are the areas a bank should look into for better management to get a better return? The first one is liquidity management. When you say liquidity management, it's the acquisition of assets that are liquid enough. Second, asset management. You're going to acquire assets with low risk of default. Then liability management, acquisition of fund at low cost. Then capital adequacy management, credit risk, and interest rate risk management. These are the key areas I'm going to touch upon. You might have seen in your banks, there would be a committee to look into these items. What is the name of the committee? Anybody? What is the committee in your bank? Look into this. Or managing liquidity, assets, liabilities. No idea. You might have heard like ALCO. So it's Assets and Liability Management Committee, right? So if you see the Assets and Liability Management Committee report, they might be discussing these areas. How to manage the liquidity, how to manage the assets, how to manage their liabilities. So here I have given the purpose. The liquidity management is important because we have to maintain sufficient liquidity. Asset management is important, so you should always think about low risk of default. And liability management, it always goes with the low cost funding. And then you also should see whether your capital is adequate and are you taking the credit risk more than your mitigants, or then what about your interest rate risk exposure? So these are basically very important. So ALCO, Assets and Liability Committee, will look into that and submit a report regularly to the board of directors. If you don't know that, just get a report and see how they do the analysis, right? Okay, so first, what you are going to see is here, liquidity management and the role of reserves, right? Now let's assume in your bank, you have excess reserves. Are you all following? Rangana, is that clear? Gavin?
Yes, it's clear.
Okay. Okay, let's assume like, okay, the first instance in a liquid management, you have excess reserves, right? Again and again, I just remind you all when I talk about reserves. So it's a fund the bank keeps at central bank. So you have the reserve account at central bank. So that fund is with central bank, right? Remember. Okay, now see the first balance sheet. Under assets, we have reserves 20 million, loans 80 million, and securities or investment, it's 10 million. So you have altogether 110 million total assets. And if you take liabilities, you have deposits 100 million and bank capital 10 million, right? You could see from this balance sheet. Now, suppose banks required reserves are 10%. That means our regulatory requirement for the reserve is 10%. So how much you have to maintain as a reserve minimum, at minimum? Anybody?
$10.
Very good. So 10 million, you have to maintain reserves. Now, currently you are maintaining 20 million, right? So you have excess reserves. So now let's assume one customer writing the check for 10 million and withdrawing the money. Then what will happen? Okay, definitely your deposit will go down by 10 million. Same time, your reserve will go by 10 million. Right? So still, you are satisfying the requirement, central bank requirement. That's a 10%. That means now you have to maintain, if it's a 10%, you have to maintain 9 million, but your reserves are 10 million. So you still maintain 1 million excess. So you don't have any issues. So when you maintain an excess reserve, you don't need to worry about a deposit outflow. Right? Clear? Okay. So when it comes to liquidity management, we have to think of how much reserve am I going to maintain. If it is excess, how much? Right? You cannot maintain anyway below the requirement. Always we have to maintain the required reserve. So if it is 10%, minimum is 10%, then definitely you have to maintain a little bit excess. So how much? It's up to the bank. Suddenly, if a customer withdraw money, you have to still maintain your reserves. Right? Okay. Then let's assume a shortfall. Kind of like, okay, now in the first balance sheet, you could see, right, liability side deposits 100 million and bank capital 10 million. And asset sides, reserves 10 million and loans 90 million and securities 10 million. It's altogether 110. Now one customer withdraw 10 million deposits. What will happen? You are going to lose 10 million out of your total deposits of 100 million. So then balance is 90 million. But same time, you are going to lose your reserves as well. So now the reserve is 0. So if you maintain as per the requirement, that is your actual level. So if there's any withdrawal, then your reserve level will come down below the requirement. Then you can have regulatory penalties. So reserves are legal requirement and the shortfall must be eliminated. That's what I have given here. You cannot have shortfalls. So it means excess reserves are insurance against the cost associated with the deposit outflow. So when you maintain excess reserve, yes, definitely there's a cost, right? That cost is incurred because of the unexpected deposit outflow that create a more impact, right? Okay, so then when we say liquid management in ALCO, this is what they discuss, and they decide how much they have to maintain. Right now, let's assume in a festival season, right, you will be losing so much of deposits, right? So then you should know, okay, how much reserve I should maintain, right? If it's based on the financial system as well. So some financial system, if you take US, It's big amounts are going through, current account, writing checks, right? In Sri Lanka, compared to maybe less. So it's based on the financial structure. Based on your experience, you have to think, okay, how much excess I should have. Okay, up to now, we have seen, okay, there can be excess or there can be a shortfall. Now, if there's shortfall, what will happen? Now you have to borrow, right? So when you borrow, okay, now your reserve is 0, right? So we have seen like 10 million withdrawal, the reserves become nil. So you have to borrow. So you can borrow. If you borrow, liability side, you will get 9 million as a borrowings. And then that would be accounted as reserves, 9 million. So why 9 million they borrowed? Because like they have the deposits of 90 million. So they should have the reserve of 9 million. So you have borrowed. The problem is you should be aware about that, the cost incurred to maintain these reserves. Because when you borrow, you have to pay for it. So when you think about, okay, how much excess reserve you are going to maintain in your ALCO, you have to think about borrowing as well. Okay, something like go against your expectations. That means a customer borrows or customer redeem their deposits beyond your expectations. So then you have to borrow. So then you have to think about the avenues where you can borrow and what is the cost of borrowing, right? That should be in the ALCO. Or rather than without borrowing, you can, if you need money, right, reserves, if you want to replenish your reserves, then you can sell the securities. The previous balance sheet, you had 10 million securities, right? What you can do is, this is the assets and liability management, right? How we are going to manage. What you can do is, you can sell 9 million worth of securities and maintain the 9 million reserves. So then securities will be deducted by 9 million. So earlier we had 10 million, now it's only 1 million, and reserves increased by 9 million. Now you are okay. So every time, so you have to think about, okay, are you going to borrow or do you have enough investment to sell it immediately, right? And that those investment also should be highly liquid, right? The problem is when you keep in reserve, you are not going to earn anything. That's the problem comes. If you are earning a good return from the reserves, right, nobody is going to care about. You can have excess reserve, but the problem is you aren't going to earn anything. So the banks always want to have less reserves, but they have to have some kind of contingency plan. If there's a shortfall, how they are going to manage that, through borrowings or by selling their investments, they have to think of. Or like if they can't borrow from others, even they can borrow from the Federal Reserve, Fed. The Fed means central bank, right? So now like these banks need 9 million, so they can borrow. Like if you have zero balance in your reserves, right, definitely the central bank can fund it and charge on that. It's not a good sign for central bank. So that's what every bank, they don't want to have this kind of shortfall, so somehow they manage it, right? So the rate, we call it always a discount rate, right? So you can borrow from central bank and you can have it as a reserve. So 9 million you are borrowing. So your liabilities increased by 9 million. And then your reserve increased by 9 million. At the rate, we call it discount rate. That central bank fix it for this kind of borrowing. Right? So when it comes to liquidity management, you have to think about shortfall and you have to plan for it, whether borrow or selling investment, or you are going to borrow from Federal Reserve. You have to have that plan. And then final options, if you are running short of reserves, you can reduce the loan portfolio. Right? If you see this one, liabilities as it is, deposits 90 million and bank capital 10 million. Okay. Now you need to have 9 million reserves. What you can do is you reduce the loans by 9 million. That means you ask your customers to pay immediately. But that is a remote chance, right? And then that's also very costly as well. In terms of finance and in terms of customer relationship as well. So customers normally antagonize when we ask this kind of unexpected, recoveries. Right? So sometimes you can sell the loans to other banks or financial institutions. Normally in a time of crisis, normally what they do is they just make a package out of some portion of loan, maybe example gold loan or like real estate or credit card portfolio. They make a package it and rating it and sell it to others. You could see in 2007 financial crisis that so many banks did that at a substantial discount, right? The discount is substantial, so then you will be the loser. So this is also another way of handling the liquidity management, right? So we know now how this basic banking business works, and during that system, how we can manage the liquidity. Is that okay? Any question? No question? Okay. So the second one, the asset management. So when you think about your bank, think about the assets, right? So assets are the like items which is going to give you a return. So there are a few things they have to consider. One is seek the highest possible return on loans and securities. So they will be always think about high return. With that, they also think about the less risk, right? And also they would think about, when it comes to a mixture of the assets, they will think about adequate liquidity. So your asset should provide a high return. It should be with less risk, and it should be having adequate liquidity characteristic. So it's a contradiction, right? If you put all together, if you expect highest return, that means high risk, right? If you expect highest return, then most probably low liquidity. Let's assume like, okay, you're going to give a loan at a higher rate. It's a more risky customer, so you are taking more risk. If you are going to invest in a share market, right? So looking at the highest return, then definitely you will have high risk as well. And similarly, if you are going to have a low risk, then you have to go for a treasury bills. Then it's low interest, low returns. And if you go for like highly liquid assets, maybe cash or treasury bills or bonds, then your returns are very low. So it's a contradictory. That's what the management is necessary for this, because these objectives are different. So you can use 4 tools in the ALCO, right? The major ones are like find borrowers who will pay high interest rate and have low possibility of defaulting, right? You have to go for that kind of customers. Or like you have to maintain a trade-off, right? So high interest rate or low possibility of defaulting, low risk. So you have to strike a balance. So you have to purchase securities with high returns and low risk. Or even if you are going for a like little bit higher risk, you have to diversify. You can lower risk by diversifying. If you are going to invest in share market, you can take hotel sector as well as retail sector or hospital sector, or maybe several sectors, agriculture sector. So one or the other can provide a return, right? Bad times, good times, maybe all the times you will have some kind of balance. And then balance need for liquidity again, increase return from less liquid assets, right? You have to maintain balance. As I said, right? If you go for high return, maybe less liquid assets. So you have to have a balance. So these 4 tools are very important when you discuss in assets and liability management committee and find a good solution for asset management, right? Okay, similarly, liability management. This is the anyway world phenomena now. The banks, the big banks, try to fund for other small banks, right? We call it money center banks, right? So you can manage your liability with that kind of large banks. You can borrow at any time, right? And due to that growth of those kind of banks, even you can get loans or borrowings overnight basis as well. So now we could see the previous slides, merely 50% is checkable deposits. Right? We also here, like we always talk about Casa, right? Current account and saving account. So everybody try to maintain this current account, saving account balances. Why? Most of the banks very keen on that. Why is that? Anybody? Why is that? I couldn't hear anybody this time. Why banks are willing to maintain always current account balances or saving account balances, deposits?
Low cost funds.
Low cost fund. Very good. So what's the risk attached to that? Bank point of view. What is the risk they are facing? Come on. I know you all know, but you have to make it very interactive. Then only you will think, different questions, and, we can have a discussion. Shaminder, what's the risk attached to Casa deposits?
Mm,
Anybody else? When it comes to Casa deposits, right, it carries liquidity risk as well. The customer can withdraw at any time, not like contractual saving account. So that means, okay, fixed deposits, right? So one side, banks are expecting to have more Casa, right, current account, saving account. Other side, you also will be carrying a risk on that. But based on the past experience, banks are thinking, okay, even though there are drop, okay, if they can maintain the interest rate parallel to, market competitive interest rate, so then they won't lose that money. Even they lose it, they can quickly capture those, right? So that is the confidence banks have. So that's what they always wanted to go for, right? Current account, saving account deposits, right? But when it comes to fixed deposits, that's what they are giving, like a little bit more interest rate, so they can have it until the maturity. Okay, so this is the liability management. The next one, what I'm going to see is capital adequacy management. The bank is always very serious about capital adequacy, right? Say they should have a proper discussion on capital adequacy. Once you miss that, definitely that is recorded everywhere globally. That's a reputation risk you will be always carrying, right? Why do we need capital? Right, we have discussed earlier this one, to absorb losses, right? So you need to have capital to absorb losses, so you can maintain a stable bank. Why a capital adequacy requirement is important? What are the requirements in Sri Lanka regarding capital adequacy? Anybody? Rangana, why capital is important? What are the requirements in Sri Lankan market? Or what are the Central Bank of Sri Lanka requirements on capital adequacy? Any idea?
Certain percentages on loans, and depending on the risk categories of the loans, a certain level of capital adequacy ratio should be maintained by the banks.
Good. Two things in Sri Lanka. We are saying like minimum capital requirement So central bank says, okay, you should have, okay, example, 20 billion rupees as capital at your minimum, right? It's a minimum capital requirement. And same time, central bank also say, okay, give certain percentage and say, okay, this is your capital adequacy ratio you should maintain, right? So always bank should have this both minimum capital requirement as well as capital adequacy ratio. That is the major item in ALCO, right? Assets and Liability Management Committee. They have to let you always, they should satisfy this requirement. And not only that, based on their business model or expected business growth, they should always think about whether our capital is sufficient, whether are we managing our capital adequately. Because when your business expands, you need more capital, right? When you have a sufficient capital, so you can avoid the bank failure, right? So bank failure means, okay, you don't have enough fund to settle the obligations or depositors' obligations, right? So if you have enough capital, you can absorb the losses, then you will be withstand with any shocks. Right? Okay, let's assume here in this example, how bank capital helps prevent bank failure. Right? I take an example. In your bank, you are going to, okay, a customer defaulted, right? You are going to write off that. Let's assume $5 million you are going to write off. Let's assume what will happen. Now I take here two banks, right? The first table, I take here two banks. One bank is high capital bank, another bank is low capital bank. If you take the high capital bank, asset size, it's 100 million. Out of that, reserve is 10 million and loans 90 million. And if you see the liabilities, deposits 90 million and bank capital 10 million. So 10 million is a big capitals, okay, high capital, I would say. So then if you take low capital bank, the reserves 10 million, okay, equal. Loans 90 million, that is equal. But here if you see, the deposits are 96 million and bank capital is only 4 million, right? Both are maintaining reserves 10 million equal, because if you assume like 10% is requirement, okay, both are satisfied. There's no violation, no breaches. But the problem is now a default, right? So bank is writing off that default. That means $5 million is going to be written off, right? If you see high capital bank, okay, when you write off a loan, what is the double entry? Can anybody tell me what is the double entry? There can be a lot of intermediary entries. I didn't ask that one. The final outcome. So final entry, the impact. If you're going to write off a customer's outstanding, what would be the entry?
Write off against the provisions held.
Write off against the provisions. Just tell me the two entries. Customer defaulted, now debit and credit. Anybody? Okay, now you have customer outstanding, right? Total customer outstanding is maybe, I'll take it here from the previous balance sheet. The high capital bank, the loans are 90 million, right? Now you are going to write off 5 million. So that means you are going to credit the loan account, right? So now, so you are going to remove 5 million out of that 90 million. So you could see from the second balance sheet, now loan amount is 85 million. So this is a loss. So if you have a loss, that means it will go to the P&L. You debit as a loss, right? So what will happen? So final impact will be on capital. You are going to write off from the capital. So that means now after deducting this 5 million loss, your total capital now is only 5 million. Clear? So now you have, right, high capital. So then you have no issue. You can run the bank still without any problem. But if it's a low capital bank, what will happen? Now your loan will be like 85 million. You are going to deduct 5 million from 90 million. So 85 million. But your capital, you had only 4 million. But your loss is 5 million. So bank facing a crisis, you have negative capital, right? You have negative capital. So you would be breaching all the regulatory requirements. And more than that, what will happen? Okay, can anybody tell me, like, okay, can you run a bank without capital?
No.
Why?
Central bank has given guidelines on minimum capital that should be maintained by banks.
Yeah, true. There's a requirement from central bank. Okay, let's assume central bank is okay. Central bank doesn't worry about that. Can you run? Okay, so if central bank allows, yeah, okay, allowed to have this negative capital for various reasons, right? Yes, they can run the business, banking business. Now I could remember, like, okay, maybe 10-15 years before, like one of the state bank, they had a negative capital, right? And central bank gave, I think, I couldn't remember exactly. Yeah, let them continue, right? So banks was running with negative capital, right? Without any problem. Then they now capitalized anyway, like after some time. But my question is, okay, that might be exceptional cases, but it's very difficult to run a bank with negative capital because it's a reputation issue, right? Because it's a customer confidence. Finally, the customers who is going to keep the money with you, they look at your capital, right? So if you have negative capital, so definitely they are not going to do the business with you unless there's a guarantee like, okay, if something happened to this bank, okay, we would look after. Maybe as an example, if it is a state bank, so if law says, okay, it's 100% guaranteed by a state, then nobody worries about whether negative capital or like high capital or low capital. But if it is a private bank, definitely, like if you are running with a negative capital, so like nobody will, not only normal customer, I'm just, okay, you may think, okay, normal customers, they don't worry about this negative capital or positive capital. I agree with you to some extent, but the people are like, okay, investors who is going to invest on your bank, definitely they are not going to invest, right? If you don't get investment from outside, so it's very difficult to grow your bank, right? So now, as you see, the high capital is very important, because when you have like unexpected losses, the capital should be there to absorb them, and you have to maintain capital adequacy at all time. That's what ALCO always discuss, this capital adequacy, right? That's very important. But same time, we also keep in mind, capital is not free. There's a high costly one compared to others. Capital is the costly one, right? So when you have more and more capital, so like if you discuss in ALCO, okay, you are going to do right issue, you are going to go for additional capital, so always there will be some kind of opposition to reject that proposals. So the major reasons, there are a few reasons, but one is, okay, you are going to have share on your profit, so you have to, right, that share may be not sufficient to mitigate the risk, right? So then it's very difficult to get the shareholders approval, right? So when you have the capital amount, so you also think about the returns out of that. So returns too are very important. One is return on assets and return on equity. I don't need to explain that. It's simple and straightforward. So then what is the proposition we can have is based on the equity multiplier, right? So what is the proportion in a total assets to equity? So that's the matter when we decide or go for a capital adequacy management. So you have to always think about the return at which you are going to pay to the shareholders. Is that clear? So finally, when it comes to capital adequacy management, the bank should think a trade-off between safety and return to equity holders, right? The two things, the return is a major thing, and then also the safety, right? So you should have like, okay, whoever investing, shareholders also investors, whoever investing on these banks, their investment should be safe and it should provide a higher return. Right? So that's what I have mentioned here. That depends on the state of the economy and level of confidence you have. Right? So every time the bank should think, okay, what's the level of confidence we have or like customers have on the banks, right? If you think it's low, the one of the way you can improve the confidence is having higher capital. An economy is going very smooth. If you don't see any fluctuation, ups and downs. So that means, okay, you're not going to lose that much. Of course, you can think of the capital level, right? How much capital you are going to have it? It's a basic questions always discussed in ALCO, right? So it's based on the safe or return and overall economic performance and the confidence. Is it clear? Any question? No question at all. Are you all with me? Is that clear? Or is it difficult? Chaminda, is that okay? No noise? Gavin, you got it?
Yes, sir. All good.
Okay, okay. So I have given some kind of application you can read and understand, right? It's kind of experience during the global financial crisis. It's kind of a research finding you can see. And as I discussed earlier, like, okay, managing credit risk, right? That's also very important item. So we discussed earlier, okay, adverse selection moral hazard in loan market. So how that works. So when you do the screening and monitoring, you can reduce those risks, right? You can reduce adverse selections. You screen the customers, so through that you can reduce the adverse selections. You can choose a right customers. And when it comes to specialization in lending, right, you still then the banks have expertise on lending, so they have all screening process in place, monitoring process in place, so you they can reduce the adverse selection. And also through monitoring process, as I said, you can continuously, after disbursing the loan, you can continuously monitor the customers. And similarly, like as and when necessary, you can have covenants to the customers. Okay, they can how much they can invest on various projects, and what are the ratios they have to maintain, gearing ratios or any other capital ratios, or profit ratios, or what are the ratios they have to maintain. So they can the bank can fix the covenants and stop the customers moving or taking unnecessary risk that is not in line with the bank's expectations, right? And when you maintain long-term customer relationship, you collect always the information that gives you wider picture of the customer's behavior, right? And also, like, some banks follow the strategy, okay, they give the loan commitments, they don't disburse. Okay, when for some time they give the loan commitments, okay, whenever you need, we will lend to you. When you give that kind of loan commitments, customer is with you and obliged to give you information. So you are not lending, but you give the commitments, but you get the customer's information and continuously monitor necessary. That's one of the, nowadays, if you see, okay, off balance sheet items are growing, right? It's one of the lucrative business for banks, so it's that reduce credit risk some extent. And next one, collateral and compensation balances. The bank also can ask collaterals, and same time you also could see like, okay, when the banks disburse loan process, they wanted to maintain a small percentage of the money in their current account or saving account. So when the current account, saving account behavior or that fluctuate, so the banks can understand the customer's behavior. So that's what is compensating balances. And also, like, there's another strategy the bank can have, credit rationing, right? Now, if customer is coming for a 10 million loan for a project, but you are not going to give 10 million, you're going to give only 1 million, right? So when you do this credit rationing, so what will happen, if you give high amount, customer can think, okay, I can default and enjoy my life. But if you go for a small amount, they will think their trade-off, okay, defaulting this small amount is not going to give him a big advantage. So then they try to settle, right? So probability of default is less if you give less amount. But also, other hand, you have to think, okay, if project requires 10 million, if you give only 5 million, what will happen? Anybody? The customer cannot do the project, so definitely he will use this money to something else. Or like, even if he spend that 5 million, he cannot complete his project, or then project is not going to earn any profit, so again loss to the bank. So in this kind of thing, that's what, like, you always go for a consortium, right? So banks can get together, few banks can get together and fund to the project, right? Okay, so managing credit risk and then managing interest rate risk. What do you mean by interest rate risk? Anybody? What do you mean by interest rate risk? Okay, when it comes to interest rate risk, so you could see the possible losses arising from interest rate fluctuations, right? We discussed already. So now, what is the interest rate risk for this bank, the overall interest rate risk? So you have to calculate the interest rate risk, then only you can manage, right? So management means it's assessing the risk and take the or formulate the strategies to mitigate those risks. It's all together. We call it management, right? So if you want to assess the interest rate risk, there can be like several methods. So one, we can see a gap analysis, right? So if you take a bank's balance sheet, we can have two different sets of assets and liabilities. You can divide assets into two buckets. One is rate sensitive assets, another one is fixed rate assets, right? So when you say rate sensitive assets, that means maybe floating rates, right? So there can be two kind of assets. One is variable rate. That means when you give the loan, you fix the rate at float. Let's assume AWPLR plus 2%. And every quarter you are going to reprice it. Right? So then every quarter you will be repriced. Right? Or the second one is short-term securities. Okay, if it is mature in 3 months' time, you have to again go for the new one. So that also will get repriced. When you go for a fixed rate assets, it's all maybe reserved. There's no interest rate, or like fixed at a minimum, or long-term loans or long-term securities. It's fixed for long term. So that means when the interest rate changes, it's not going to affect these interest rates. But when I say rate sensitive assets, when the market interest rate changes, definitely it's going to affect that. So similarly, liability side, you can see rate sensitive liabilities and fixed rate liabilities. So when it comes to rate sensitive liabilities, okay, saving account, short-term fixed deposits, any other securities, as I mentioned here, like money market deposits accounts, those are very short-term. So it's sensitive to the rates. But when you take fixed rate liabilities, right, checkable deposits, saving deposits, long-term CDs, right, equity capital, those are fixed, right? Checkable deposit, we don't pay any interest rate. Saving deposits, once you fix it, you don't need to change it, right? Or long-term CDs, equity capital, these are from liability sides, fixed rate liabilities. So we know now these fixed rate assets and liabilities are not subject to interest rate risk exposure. Because even though the interest rate in the market changes, these interest rates are not going to change. But interest rate sensitive assets and liabilities, they are exposed to the risk, because whenever the market interest rate changes, these interest rates are also going to be changed. So what you have to do is you take interest rate sensitive assets and interest rate sensitivity liabilities, and you deduct these interest sensitive liabilities from the interest sensitive assets. So you get a final amount, we call it gap. Which one is better? Positive gap or negative gap? I hope you understand. You take interest rate sensitive assets, and from that you deduct interest rate sensitive liabilities, and then you get a gap, net figure. That can be positive, that can be negative. If interest rate sensitive assets are higher than the liabilities, interest rate sensitive liabilities, you will get a positive gap. Or if the interest rate sensitive liabilities are higher than the interest rate sensitive assets, then you will get negative gap. My question is, which is better, positive gap or negative gap? Rangana, which gap is better?
Positive.
Why is that?
Assets are higher than liabilities. Therefore, in any case, if we have to meet our liabilities, we can go for assets, realize our assets.
What do you mean realize our assets? Are you going to sell it off, or okay, let's see from others. Gavin, what do you think? You like positive gap or negative gap? Which one is better?
I'm not exactly sure. I don't know.
Okay, why we need to see this gap? Actually, like, don't get it confused. Here, what I'm talking about, the interest rate risk, not liquidity risk. You also can assess liquidity risk. That's also similar way of doing. You take assets and you deduct liabilities from that. We call it maturity gap, right? So we put different maturities into different buckets. We put the assets first and deduct those similar maturities liabilities and get the gap and see, okay, whether it's positive gap or negative gap. So if it is a positive gap, of course, we know we have more assets than liabilities, right? So then we can be sure, like, okay, we can settle these liabilities using our assets because we have more assets and liabilities. Those are maturing in a particular bucket. As an example, okay, you have 1 million deposit worth of deposits that maturing within 3 months, and you have 1.5 million treasury bills that maturing within 3 months. So now you are sure, okay, I can sell this treasury bill 1 million and settle this 1 million deposits because I have the assets more than the liabilities. That is liquidity risk perspective. Here, what I'm talking about is interest rate risk perspective. We are trying to capture interest rate risk. Now, let's assume if it's a positive gap. If it's a positive gap, that means interest rate sensitive assets are more than the liabilities, right? So now let's assume market interest rate increased by 1%. Then all these assets and liabilities, you are going to reprice them. That means increase by 1%. When you have positive gap, that means more assets, the assets will have, all the assets will have 1% increase. When it comes to the positive gap, that means assets are more than the liabilities, you will have more profit. It's an interest rate increasing scenario. But in the case of interest rate decreasing scenario, the all assets and all liabilities will be repriced by reducing 1%. But the problem is the liabilities are less, your assets are greater. Then the greater assets would be repriced by reducing 1%. So then that means you are going to lose your income. You are going to end up with losses compared to previous time. That means whether you can have it positive gap or negative gap, it doesn't matter. The matter is whether interest rate is going to go up or down. When you have positive gap, increasing interest rate scenario is better for bank. But decreasing interest rate scenario, worse. But when you have negative gap, increasing scenario is worse. Right? In a negative gap, when the interest rate increases, your liability, that means you are going to reprice your liabilities. Then you are going to have more cost. So if you have a negative gap, decreasing scenario, interest rate decreasing scenario is better. So it's basically based on interest rate expectations. So in your assets and liability committee, in your ALCO, you discuss this expectation. And you just, change this characteristic, whether you are going to have fixed rate or whether you are going to have rate sensitive. So you are going to discuss and fix it. Right? If you think, okay, it's you will lose, then definitely your loan portfolio or new loans will be, most of the time, they go for a variable rate. Right? So it's an interest rate risk. So you should be able to analyze that, and you should have some kind of strategies to mitigate them as well. Right? Okay. So this what I have explained here. You can think of, right? This is just calculation as you mentioned. Like you can basic gap analysis, you can see. You are going to take the rate sensitive assets and deduct rate sensitive liabilities and multiply by the expected interest rate change. That means if you think, okay, interest rate is going to increase by 1%, you are going to multiply by 1%. So that means the final outcome would be the change in the profit. Right? So how do we prepare this maturity gap and all? You can learn. That's what I ask you all to go through the ALCO report. There will be some kind of analysis. So it's better to, understand in the practical sense by going through those reports. Right? Okay. And then I'm just going to discuss about off-balance sheet activities as well. When you do the managing part, right? So the off-balance sheet activity is also very important. Right? In a banking business, we have to consider that as well, because it's an increasing trend now. Most of the bank concentrating on fee-based income. That means off-balance sheet activities. It can be a loan sale, right? Or it can be a securitization, or it can be a trading activities, kind of financial futures, options. They can trade, right? Swaps and all, right? However, like principal agent problem also can arise. We have to always think about that. So keep in your mind, shareholders and the managers, right? So shareholders' expectation should be fulfilled by managers, or maybe if you take a bank, okay, shareholders, and when you say management means it's a board of directors, CEO, and senior management, right? So the principal agent problem would be always there. So we should take into account those. In addition to that, to avoid the principal agent problem, you can have separation of trading activities and bookkeeping, or limit on exposures, or value at risk, or stress testing you can performance. So these are the ways you can manage your risk, right? I have given an example as well for this principal agent problem. Now you could remember the Bearings Banks issue, or wherever like you go for kind of discussions. Everybody talked about that. This bank is 100 years old, very old bank. Even the British Queen had the account. That's what it says, right? So it's within a short period or time frame that bank collapsed. The story behind that is the banks, they have the treasury, trading desk, and the middle office, right? So there were no proper controls, segregation of duties in between trading activities and the middle office functions and bookkeeping as well. So it's a single a combination of functions. So one person, right, he did the trade and then he did the bookkeeping as well. So he has hidden his exposures through his bookkeeping because there's no separation of duties. So he could hide those. So suddenly this Tokyo stock exchange that collapsed. So his exposure to the exchange was huge, and finally he lost. So basically one trader brought down this bank, a 100-year-old bank, because of a simple lack of control mechanism, right? So always the principal agent problem could be minimized, cannot be eliminated anyway. So various risk management techniques. So that's what we should have always, proper internal control system. We can think it's a simple matter, but I had several instances like when we go to on-site examinations, the officers think, okay, these are smaller things, right? But when it comes to an issue, right, anybody can play around with that, right? So this is off balance sheet activities, right? Up to now, what I have seen is, what we have discussed is basically all about banking business, right? Banking and managing of banking business, right? So now like how financial institutions fit into financial system, what are the services they are providing, and how they functions, and what is the importance of capital, and what are the areas a bank should consider in managing banking business, right? Okay, so under financial institutions, one more sections we have to discuss, that is regulations, right? So what I'm going to discuss here is not the Fed or US regulations, is a Sri Lanka banking sector regulations. When it comes to financial institutions, even though we see banks, finance companies, leasing companies, stock exchange, stock brokers, insurance and all, as we discussed, the major part is from bank, right? Major players in this market is bank. So I'm just going to discuss with you all the salient features of bank regulations, right? Okay, so then up to now, do you have any question under financial institutions? I heard like past papers already uploaded, then you can go through. So questions might be similar, even though this time we changed slightly syllabus, but anyway those covers the almost all the areas. You don't need to worry about that. So you can go through the past papers and the question would be, I think, similar to that. Okay, if there's no questions, so I'm just going to look at the regulations or regulatory framework. And also, I just want to inform you all that we'll be having 2 classes, one on Saturday and Sunday next week. So that would be the 2 last sessions. Saturday morning might be, anyway, they will inform you, and Sunday as usual time, right? So we will finish it off. And also, like, maybe at the last class, we can look into a kind of questions, how we can, respond to those questions. So keep in mind Saturday and Sunday, but anyway, like IBSL will confirm to you. Okay, when it comes to regulation in Sri Lanka, like central bank is the authority responsible for the administration, supervision, and regulation of the monetary, financial, and payment system in Sri Lanka. So monetary system, yes, central bank responsible, and financial system, yes, central bank responsible, and payment and settlement system, that's also central bank responsible. So regulator role is towards these 3 systems, right? So if you see the objectives of the financial system stability, here I'm not going to talk about other objectives because we are talking about the financial institution here. So the central bank has 2 core objectives that we already discussed, right? One is economic and price stability, other one is financial system stability. So the financial system stability means, right, the financial system in Sri Lanka that should be able to withstand with any shocks, right? Maybe internal or external, right? Okay, so that is the job of regulators. Why that is so important, right? Why these banks are so important? Because as we discussed, more than 60% of the financial sector assets are accounted by banks. And second, banks are highly leveraged institutions. That means the capital may be 10 to 15%, but balance is outsiders' fund. Then third, bank take risk. So regulations are very important to safeguard those institutions. So that's what always it's a highly regulated institutions. But you could see here, Alan Greenspan is the president of Federal Reserve Board, right? He stated, we should not forget that the basic economic function of these regulated entities, that means bank, is to take risk. Bank, that means bank and risk is all about taking risk. You cannot stop, right? You can't say, okay, don't give the loan, because like that's a basic business. So if you're going to give the loan, definitely you're going to take the risk. So you cannot avoid that, right? So every bank will take the risk, but we have to minimize those risks in order to reduce the failure rate, right? So he says we cannot eliminate. If we try to eliminate the risk, that means we are going to eliminate the purpose of banking system. So he said you cannot eliminate, but try to minimize, right? So something happened. So if a bank run, so everybody try to blame central bank or banks, but you cannot control, right? You try to reduce the risk taking, but you cannot eliminate. So if somebody is taking excessive risk, sometimes that leads to bank run. Okay, so here like I'll be going a little bit faster. So then just stop me and ask if you have any questions, right? As I said earlier, a central bank, when it comes to central bank, so central bank is established under Monetary Law Act right? So monetary law act says what are things Central Bank of Sri Lanka can do, right? Under that act, right, based on that, so Banking Act enacted. So Banking Act specifically for banks, what they can do or what they cannot do, right? So it defined the basic functions and the monetary mechanisms and any other requirements for banks. So Banking Act is the key act that gives you a regulatory framework within which the banks can function their business. If you take the key aspect of the Banking Act, it talks about licensing of banks, payment of license fees, right? And approval of the monetary board to carry out certain transactions, compliance of persons and banks suspected of carrying on banking business, alteration of memorandum of articles, right? So many things are listed out there. Licensing, restriction of the use of word bank, operating subsidiaries and associate companies, maintenance of capital, maintenance of liquidity, payments of dividend, offshore banking business, preparation of annual report, appointment of an auditor, disqualification of for being appointed as a manager, secretary or CEO and senior management. That means fit and proper. And power of the director of supervision, bank supervision, and monetary board to give directions, conditions for the grant of loan by way of accommodations, abandoned property. So if you take the Banking Act, you go through the contents page, it talks about so many things, right? So key things I have listed here. Like if you want to go into detail and see every time, you can think of each and every item. Just if you're an ALCO officer, just an example, right? You want to know about the liquidity requirements, right? You first go through the Banking Act. Under that, it says, okay, about liquidity. You can read out. Then you can go to the direction. So based on the Banking Act and Monetary Law Act, the central bank issued direction to the banks. In the directions, it clearly explains what is the regulatory mechanism or framework for each and every item mentioned here. That is in detail. This kind of broad perspective, this Banking Act, but in detail, the procedure. Now, if Banking Act says, okay, you have to maintain sufficient liquidity, so then this direction will say, okay, how to do that, right? Okay. Any question? No? Okay, so first it talks about licensing. Based on this Banking Act, so it prohibits like anybody is carrying banking business without a license, right? License issued by Monetary Board of Central Bank of Sri Lanka with the approval of Minister, right? So if somebody is going to have banks incorporated outside, so then that should be fulfill the Companies Act requirement. So anybody is going to start a new bank, they should apply to the Monetary Board with the articles, and after evaluation, if central bank satisfied, you will get provisional approval, right? And then after evaluation, then you will get a license, right? It's a licensing mechanism. Like if anybody wants to start banks, they will go through this procedure. So when they issue the license, it says, okay, so whether you can carry out banking business, whether it's domestic or whether it's offshore, or like which place you can have the banking business, and what are the terms and conditions for license, right? And also this act says what is meant by banking business, right? What are the activities they cannot perform, that also given in the Banking Act, right? So this is all about licensing. And banking business, it's clearly say bank business means the business of receiving funds from the public through the acceptance of money deposits payable upon demand by check, draft, order, or otherwise, and the use of such funds either in whole or in part for advances, investment, or any other operations. So like this, when you read this, may be very simple and straightforward. That means accepting deposits and lending or investment. But even we have seen, like, okay, some of the businesses are not coming under this purview, right? So then the regulator should require them to immediately stop those, right? So whenever the banks wanted to have a new business line, right, they should clearly check with this requirement. Or if they don't understand, they have to write to central bank and get it clear. So central bank can give no objection letter for this, right? Now, see an example like this, even though we are talking about banking business here, right? So finance companies, we call it finance business, right? But similarly, if you take a finance company, they will do so many business, right? So the central bank should see whether these businesses are coming under definition of financial business. If it is not, you have to, ask them immediately close down. And if there's any regulatory action, you have to take it. Right? Clear? Okay. So this act talked about banking business. You cannot go beyond that scope, right? And every time for certain item, you have to get the monetary board approval, right? If you want to open, close, or change in location within Sri Lanka, right? To open, close, effect any change in the location outside Sri Lanka, to acquire the business of a licensed bank, to open a representative office in Sri Lanka, merger consolidations, or operate mobile banking unit, you need monetary board approval, right? If you're going to have mobile banking unit without approval, then that's a problem. So the banks nowadays, like, okay, they start mobile banking unit, especially during the COVID. So approval given for the banks to do that, right? So every time you have to get the proper approval. And also I just try to cover up the major areas. Other one is acquiring a material interest. Now, if a bank wants to, if a bank, right? So there are shareholders. If a shareholder wants to have, or like if he has bought shares, right? That is more than 10% of the banking total shareholding, right? That's a material interest. So nobody can buy above 10%, right? If you're going to buy it, then you have to have monetary board approval, right? There are few banks. This may be a problematic area, right? Why? So one individual, it says not only one individual, but also acting in concert. So few people can get together and try to buy or hold the shares. Why it's prevented? Because, like, they can, like, if somebody wants to control, if they get it, like, get the opportunity to control the bank, so they can do the unfair treatment, right? So personal gain also can be obtained through that kind of control. So the central bank regulations are clearly preventing those kind of acquisition, right? And this bank can also talk about capital requirement, reserve funds, and maintenance of liquid assets, right? Always the bank should comply with these capital requirements, statutory reserve requirement, and maintenance of liquid assets. Otherwise, they have to get a special approval from central bank for non-compliance, right? I've given here minimum capital requirements. You can see the aspect of minimum capital requirements. We already discussed that. And capital adequacy ratio also we discussed, right? So all the banks should maintain at all time the capital adequacy ratio. And it's basically a Basel requirement. So then every countries customize those requirements and issue to the banking sector for compliance, right? Any questions up to now? Rangana, is that okay? So many people are in silent. Raja Karuna or Chaminda, is it okay?
Yes, sir.
Okay. Just you may be thinking, okay, for your work, for time being, some of the aspect not directly relevant to you, but these are directly relevant to the subjects. So whenever you go around throughout your bank and moving to one department to other department, definitely you need to understand, at least keep in your mind, okay, these aspects are in directions and banking act, and there are a lot of regulations behind your each and every work. One of the aspect what we see in on-site examination, that means when we go for on-site examinations, when we check the liquid assets requirement returns, the officers, when we ask some questions, so officers used to tell, right, no, this is the previous person was doing like that, I'm just continuing that, right? So this kind of responses we usually get from the officers, not only for liquid, like most of the time. So what I want to say is, okay, if you're doing some particular job in your bank, you go through these rules and regulations clearly. You may have a lot of doubts when you put it to work, so even you can call bank supervision and get it cleared, or you can write to bank supervision and get it cleared. So please go through the rules and regulations, right? That not only safeguard the banks, but also you safeguard you as well, because when the problem comes, that will be fixed with you, not the bank. So within your bank, officers might be penalized. So that's what I just wanted to tell you all. Like, this may not be directly relevant to you sometime, but you should be knowing that, okay, these are in place, right? Okay, so next one is maintenance of reserve fund, right? We discussed this reserve fund in previous slides, right? This reserve fund, actually, whenever you earn profit, right? Whenever you earn profit, you have to assign 5% of such profit to a reserve fund, right? When it reaches like 50% of the paid up capital, then after that, you have to assign 2%. So you have to create a reserve fund. Every time you have to annually, you have to transfer 5% of your profit to the reserve fund. And then if after 50% of the capital, right? So then you have to transfer only 2% when it comes to 100%, right? So this is also one of the requirement. Just see whether some of the banks anyway, like they have a sufficient reserve fund, they don't need to transfer anything. But if you're in shortfall, you can see from your financial statement that's they are still transferring or not, right? That's one of the requirements. Another one, maintenance of liquid assets. Other one is maintenance of liquid assets, right? So every licensed bank, hold on for a while. Okay, every licensed bank should maintain liquid assets ratio. How do we calculate? There are items that can be considered as liquid assets is given, and we have to divide that liquid assets by total liabilities. So total liabilities also given how to compute, right? I have given here when you say total liabilities, you take the total liabilities of the bank, right, and deduct the liabilities to CBSL, shareholders, and some of the other items, right? So then you are going to maintain 20% of those. So if you have more than 20%, so then that's satisfying the central bank regulation. So it's a maintenance of liquid assets. So Banking Act given necessary details, and also you can see like so many directions issued how we can operationalize this kind of requirement, right? And as I said earlier, you have two units. One is DBU, other one is OBU. DBU means domestic banking unit. The second one is offshore banking unit. So it's clearly given what are the business activities DBU can perform and what are the activities OBU can perform. So just I have given that DBU, okay, deposits, borrowings, investments, and maintaining branches and all, right? A DBU can do that, right? That's I have given, you can read and understand. And then offshore banking businesses, right? You could see like these are two licenses, right? DBU, you have to get a separate license, and if you are going to have OBU, offshore banking unit, you have to have separate license as well, right? So there are activities listed out there in the license, right? What are the activities you can carry out, right? So basically business with non-residents, right? You can borrow in foreign currency, right? You can engage in any designated foreign currencies. Okay, there are foreign currencies listed out, so you can engage with those. And even you can get the monetary board approval to engage with some other currencies as well. And how to deal with BOI companies, all given, right? So now when it comes to offshore banking unit, you're going to deal with offshore banking activities, right? So you can keep in mind. And also it talked about accounts, audit and inspections. It's nothing to nothing complex here, you can read and understand. So you have to have financial statement that should be audited, and how often that should be published, and published in all 3 languages, all given there, right? So basically everything is regulated, and even list of qualified auditors. So director bank supervision um, is having the power to give a list. Okay, these are the auditors can do a bank audit, right? That's qualified auditors. And then it gives the powers to monetary board to examine the books and accounts of a bank, right? You have been given, that means central bank is given uh, with all necessary authorities or power to go to a bank and inspect, and not only bank or their subsidiaries as well. So they can go and inspect not only books, minutes, accounts, cash, equities, vouchers, anything, right? So nobody can stop that. So that is given in the act. And also you could see, we call it fitness and propriety of senior management. This can be now whoever going to be appointed director, CEO, or senior management, they have to get the approval from central bank. Central bank should say, okay, they are fit and proper to perform these functions, right? So when it comes to evaluation, the central bank will look into that academic and professional qualifications, age, and their declarations. Everything will be assessed. And there are so many regulations under that, right? So how directors can be appointed, independent directors, so many executive directors. There are senior executive directors, several categories are there. So that's given. So based on those criteria would be this senior management would be evaluated, and then the central bank will their approval. So there's a fit and proper clause also there. That's what every time, like whenever there's a changes, they write to central bank, especially bank supervision department. So whenever we say officers performing executive functions, these are listed here, right? Who can be considered as the officers performing executive function, because it's bank to bank, it's different hierarchy. Some may be flat hierarchy, some may be like pyramid hierarchy. So it's very difficult. So names also given, but now there are changes in the directions as well. The 2 layers below CEO also considered into that. If you have a flat hierarchy, so you can write to central bank and choose whoever officers performing executive functions. And then control over the licensed bank. The director bank supervision can issue an order if the bank is engaged in unsafe and unsound practices and contravene the provision of the act, right? The monetary board can issue direction to licensed bank in order to ensure the soundness of the banking system regarding the manner in which any aspect of the bank of the business of such bank is to be conducted. So it's kind of unlimited, or I can't say unlimited. So maximum power is given to the monetary board. They can issue direction if they think, right? The bank supervision director can think, okay, this bank is doing unsafe and unsound practices. Of course, they can issue order, and monetary board can issue direction to safeguard the banking system, right? So anything can be brought under that. For my personal view, like if the central bank thinks that any other activities that undermine the soundness of the bank, yes, of course, they can direct the banks. Finally, under regulations, we also should know about the Sri Lanka Deposit Insurance Scheme. It's a safety net tool in the sense, okay, now like depositors, small deposit holders, if bank is collapsed or bankrupt, they can get their deposit back from the fund, that is Sri Lanka Deposit Insurance Scheme, maximum of 1.1 million, so 11 lakhs. Up to that they can claim, right? So this scheme is a safety net to have a public confidence on the banking system and protect, as I said, protect small deposit holders. Every bank should pay the premium quarterly. So this fund is operated and managed by Central Bank of Sri Lanka. When the license is cancelled, so compensation will be paid. So many finance companies, deposit holders, they got the money due to this deposit insurance scheme, right? So that also one of the key aspect into this regulations. So up to now, we have seen the financial institutions and its regulations in Sri Lankan perspective, right? So again, I recall, we discuss financial system, and then we discuss interest rate analysis, right? And we discuss financial structure, financial institutions, and regulations as well. Okay, if you have up to now on this chapter any questions? If there's no questions, so I can move on to the fourth chapter. The fourth chapter would be central banking and conduct of monetary policy. Right? Here I have given some introductions about central banking. Actually, like central bank, it was started by, the name was Risk Bank, right, in Sweden in 1668. And then actually the fully fledged central bank was established by Bank of England in 1694. So that is the very first fully fledged central bank. But anyway, history started with Risk Bank in Sweden, right? So now if you take this central banking, I would be taking as example Federal Reserve. So that's a complex banking system. So we can understand from that perspective what is all about central banking. There are okay. Now when it comes to central bank, right? The key purpose of central bank, right? That's also, we can call it sole purpose of central bank. What is that? Anybody? Why do we need central bank? Any idea why do we need central bank? No? Okay. Now, when it comes to central bank of Sri Lanka, we always talk about two core objectives. One is economic and price stability and financial system stability. The first one is price stability. that is the key objective of any central bank world over, right? Some of the banks, central banks, they also having this financial system stability, but some of them are not. But the key one is price stability. So in other words, a central bank should safeguard the local currency, the value of the local currency, right? So every country has got to have central banks nowadays. But there are so many arguments. Who is the owner of central bank, right? Some of the countries like government owns central bank, maybe through in the sense, own means not controlling, I'm talking about, but the establishment, right, made by central bank. But some of the countries, it's a private ownership, right? So the banks, if you take here in central bank, it was established by the Monetary Law Act, right? So it's, an entity, independent entity, right? Anyway, responsible or accountable to Parliament, right? If you take Federal Reserve, right? So commercial banks owns the Fed, right? Investment and all, everything is from Federal Reserve, right? So there are questions with it should be public ownership or private ownership, right? I have given those explanation as well. You can go through. And globally, the variations you can see from the functions of each and every central bank, right? So it's basically based on the economic structure or financial system on that particular country. Now, if our setup is totally different, maybe from UK, right? So UK anyway, like those days, Bank of England, they used to have only one objective, but anyway, like they have created another entity now to looking after financial system stability as well, right? And some of the central banks are fully independent from fiscal authorities. That means the whoever, like, the making fiscal policies, maybe most of the time government, so fully independent from political institutions. But some of the countries, maybe their structure is different, right? And their tools may be different. It's basically based on the structure of the economy and the sophistication of financial system. So it's very difficult to compare the country to country scenarios, but that's what, like, we always go with the Federal Reserve, so we can understand the basic principle behind that. I have given some idea about the Federal Reserve also. Then you can compare those with Sri Lankan central bank, right? In US, we call it Federal Reserve Bank. That's the central bank. Sometimes people call Fed. Like if somebody talk to you and talk about Fed, you should be able to understand, okay, he is talking about the Central Bank of United States, right? As I said, it's owned by member banks, right? But anyway, the US Congress can have oversight, right? So federal supervises and regulates the financial institutions, right? So that is their system there. But here, the central bank, of course, regulate and supervise financial institutions, but that is not owned by the member banks, right? Okay. Even Federal Reserve Bank, when somebody said, actually, like there are 12 Federal Reserve Bank in US, right? But the major role played by Federal Reserve Bank, New York, right? So if somebody says, okay, Federal Reserve Bank, it indicates the New York, right? So Federal Reserve Bank of New York, they are the key player, right? And I think like three three Federal Reserve, I think, New York and Michigan, another one, like they three altogether control 50% of the financial assets, so financial system. So that's what they are, the key players, and New York is the one like finally, you know, deciding a policy making body. Okay, so but here in Sri Lanka, right, no other questions, it's straightforward. We have only one central bank, right? It does everything. Now, you know, background of central bank, and as I said, the central bank's key objective is to safeguard the value of domestic currency, right? Okay, so next we are going to discuss about money supply process. This is one of the major item in our syllabus, right? So you should be able to, maybe a little bit technical, but you should be able to understand that, right? Up to now, any question? Are you all there? Rangana, is that okay?
Okay, sir.
Okay. Yeah, thanks. Now, when it comes to money supply process, right, there are three stakeholders. They are having significant impact on this money supply process. The one is central bank. Second one is banks, other banks, especially commercial banks, right? And third, depositors. Central banks, banks, and depositors. So money supply is the mechanism, right, that involves with these three stakeholders. Now let's see, if you take a central bank balance sheet, right? Now look at this. This is a Federal Reserve system, so it's a Federal Reserve bank, but you can assume as a Central Bank of Sri Lanka. If you take the balance sheet, right, this is very key. This is the base for any understanding, right? If you take the central bank balance sheet, you have assets and you have liabilities. If you take the liabilities, the one major item is currency in circulation. The central bank issue the currencies, and that is a liability to the central bank. Okay, public holding those currency as the assets, and that is a legal tender. They can buy goods and services by using those currency. So central bank liable for that. And then reserves, right? Could you remember we discussed reserve, right? So when it comes to reserves, the banks keep their money or deposits in central bank, right? That is called reserves. And that includes, right, vault cash as well. But anyway, that's reserves, right? Okay. And asset side, you can see one is securities. Let's assume the Central Bank of Sri Lanka invest on government securities, right? So then that securities coming here, or central bank can earn interest as well. In addition to that, Central bank can give loans. We discussed that earlier. So loans to financial institutions. So asset sides, securities and loans to financial institutions. But liability side, currency in circulation and reserve. Right? So loans we discuss, this called discount loan, right? In US. So rate we call it discount rate. So if you go through in textbooks, the interest rate charge on those loans called discount rate. Okay, so this is a central bank's typical balance sheet. Here the important thing is, right, we call it high powered money. High powered money, the meaning itself, the term itself tell you the meaning. It has sufficient power, right? Highly powered. You can use it for anything, right? So that is we call monetary base, MB. So when it comes to monetary base, we call C plus R. So if somebody is stating that or talking about monetary base, that means that includes currency in circulation, total reserve in the banking system. So this what? Now in the table, the currency in circulation and the reserve, we call it high powered money or monetary base. Clear? Right? Monetary base. These calculations and names are very important. Okay, now let's assume why. Okay, before discussing this one, I just want to know why do we need money? Why do we need money? Anybody? Okay, why do we need money is like, we need money to buy goods and services, right? So the central bank should ensure sufficient level of money is available in the system, to buy goods and services. If central bank maintains too much of money, then you will have inflation. If central bank maintain very little money, you will have deflation, right? So then you should be able to maintain your money at the right level to maintain your price stability, right? So now the central bank, the monetary base should be maintained at right level to safeguard the value of the domestic currency, right? Okay, for one of the way central bank try to maintain monetary base is through open market operation, right? Okay, what do you mean by open market operation? The central bank can issue securities or buy securities. Through that, the central bank can manipulate the monetary base. Clear? Or reserve, right? Or we can, reserve is part of monetary base, right? Okay, they can manipulate. So every time central bank think of, okay, how much monetary base is needed, based on that, they perform open market operations. Clear? Okay, now let's assume if central bank do the open market purchase, that means the central bank going to purchase securities in the open market. We call it OMO, open market operation. In that operation, central bank is going to buy securities. You can see these T accounts. Always remember these T accounts. Right? Okay. Now what will happen to the banking system? Okay, if the open market purchases from a bank, what will happen? Now central bank is going to get back the securities. Right? So when the central bank is going to get back the securities, so bank is going to give the securities back to central bank. Let's assume government securities, right? Going to give it to central bank. So the bank is going to lose 100 million securities. How central bank is going to pay? Central bank will credit that 100 million to the reserve account of that bank. Reserve account we have already discussed. You can recall it. The banks maintain an account in central bank where it has reserve. Right? That's a statutory reserve. Right? Now the bank, within the bank balance sheet asset side, they credit securities and debit reserve account. Here under Federal Reserve, that means like central bank account, under liabilities, reserve is going to increase because liabilities, like central bank should pay back to the bank. That is a reserve, right? And also central bank got the securities back, government securities. So then 100 million increase. So the central bank balance sheets looks like this. That means asset increased by 100 million, liabilities increased by 100 million. But banking system balance sheet, securities declined by 100 million and reserve increased by 100 million. Now you can see a reserve increased by 100 million. That means the monetary base increased by 100 million. So if central bank wants to increase the monetary base, what they will do? They will buy securities. This is open market operation. Is that clear? This is very important. Is that clear? Now what they can do, this bank with this reserve, what they can do? Why central bank is doing this one? Dilshani? Why central bank is doing this one? Open market purchase. Or Chaminder?
money supply.
Why they wanted to increase reserve? What bank can do with that reserve now? Gavin? You are right now. They wanted to increase the money supply. Okay. Why is that? Now, as I said earlier, like central bank will always look at that, right? How much money needed, right, to buy goods and services. If market is facing any liquidity issue, or market requires liquidity, or people need more loans, right? So like, okay, financial system requires more money. So if central bank assess like that during this, the pandemic situations, right? So like central bank wants banks to lend more, right? So then they have to increase the monetary base. So one of the way they can do the open market operations, through that they can purchase the securities. And now due to that, so banks reserve increased by 100 million. Now they cannot have this 100 million just idling, sitting on the reserve account. No, bank should lend that. Otherwise, bank is going to lose the interest or return out of that money. Now, monetary base, so central bank wants to increase the monetary base. Yes, of course, they can do open market purchase from the bank. Right now, the banks can lend more. So this is the purpose of that. Right now, you know why this open market purchase happening, the reason, and second, how this transaction accounted. I need you all to understand this, the T account. So every time you can think of correctly. If you forget this T account, like sometimes it may be very difficult to understand the scenarios, right? Okay. Now earlier we discussed open market purchase from bank. The second scenario may be open market purchase from the non-bank public, okay, other than these banks, or maybe we assume the public, right? So central bank purchased the securities from the public. What would be the treatment, right? So when the public sell the securities, the public will they get the money, right? So then this will be increased, checkable deposit will increase, right? But the securities will go to anyway central bank, right? It goes through bank system to central bank. So then again the central bank will get the security back and credit to reserve account. So central bank, of course, similar position will be there, but in banking system now they will increase the reserve account as well as checkable deposits, because assume current account. So because the customer will have the money in his current account, right? So then the results, the final results to the central bank would be same. But banking system, the results would be a little bit different. right? If you take the non-bank public account, now they had initially they had this 100 million securities. Now they sold and got the money back. So if it is a currency, if they get it via currency, so then definitely the central bank liability is not the reserve account, so it's a currency in circulations. So now you have to think two ways. The central bank can get the securities and credit the reserve account or pay back currency. If it is a reserve account, the liability under reserve account will increase, or the currency in circulation that's also listed in liabilities that will increase. Is it okay? But when it comes to bank, it's only the reserve account. But when it comes to non-bank public, finally, if you take this non-bank public account and Federal Reserve or central bank account, here the public, they are going to lose their securities and get the currency, equivalent currency. Central bank account, they get the securities and also the liabilities would be currency in circulation by additional 100 million. So you could remember now the previous slides, what is meant by monetary base? It's a currency in circulation and the reserve. So whatever happens now, whether increase by currency or increase by reserves, both are increasing monetary base. For central bank, both are same, because central bank wanted to increase monetary base or decrease monetary base. It can be through reserves or it can be through currency in circulation. So in summary, open market purchase, the effect of an open market purchase on reserve depends on whether the seller of the bond keeps the proceeds from the sale in currency or in deposits, right? If they want to keep in currency, that is currency, or if they want to keep in deposits, so that's a reserve. But anyway, this open market operation increases the monetary base, right, by the amount of the purchase. So this is the purchase, open market purchase. Anybody has any question on this? No question? Okay, if there's no questions, so then I can look into the sale as well. It's other way around, right? So open market sale, if central bank wants to reduce the monetary base, that means they can sell the securities, right? So they can sell the securities and get the money back. Right? Okay, now let's assume now this is in between non-bank public and Federal Reserve. If they want to, hold on. Okay, I will go through this one, deposit to currency, right? Okay, now non-bank public and banking system and central bank, right? Now, central bank is going to sell the securities, what will happen? Any idea? Can you all hear me? Up to now, any question? I'm just going to ask one by one. I'm not sure whether you all are following. If you don't follow, then the next one may be more difficult. Do I need to ask one by one? Chaminda, is that okay? Or you all want any further clarification?
Yes, sir.
Yeah, okay.
Yeah.
Okay, okay. Rangana, are you sure? That's fine.
Okay, sir.
Okay, so then if there's any question like, okay, if what are the measures a central bank can take to increase the money supply, right? And with the examples. So is it possible to understand and write the response? Just think about. Definitely you will be getting a question on money supply or like monetary policy, conduct of monetary policy. In that there can be various type or like various questions. For all the questions, this might be the base, and open market operation is the key one, right? So just in a simple language, if central bank wants to change the money supply or increase or decrease the money supply, they have so many tools to do that. Why central bank needs to change the money supply? Because central bank's objective is to maintain the price stability. In other words, safeguard the value of local currency. In other words, no continuous increase in the price level of general price level, or no unnecessary fluctuations, significant fluctuation in the price. So central bank always wants to maintain the price stable. Then they will assess, okay, this is our production, this is our goods and services availability. So what is the money supply needed to purchase these goods and services? So central bank try to maintain that level of money supply, which can lead to a stable price. Because if the price goes up and down, the consumer or producer or investor, nobody can make a rational decision. So price is very important. So central bank, to maintain the price stability, they will try to use several tools. One of the tools is open market operations, OMO. through that, what they can do is they can buy securities or sell securities, and they can get back the money. In a simple example, central bank print the money and issue to general public, and you have notes and coins. Now central bank think, right, you have excess money in terms like, okay, excess money supply. So central bank want to absorb those money. What they can do, they can sell the securities to you and then get the money back. We call it contractionary monetary policy. Money supply strained. Other hand, if they want to expand the money supply, okay, central bank thinks, okay, the people should have more money, then they can demand more goods and services. So what central bank can do? They can purchase the securities and give the money. So public will have more money. Now they can demand more goods and services. In a crisis situation, in the sense like this kind of economic downturn or pandemic. So if central bank wants to activate the economy or going forward, the central bank always wants to have more money in the hands of the public, so they can buy goods and services, more goods and services. So then producers will produce more. So economy, without stringing or like going downturn, it can survive for a while. Then if everything is calming down, then they can pick up. So it's kind of so make stable in a short term, so long term will be followed through. So central bank in a crisis situation or like economic issues, this kind of pandemic, they issue more money, right? So one of the way they can do continuously open market operations, right? Purchase the securities and give the money. Now you can see in this previous, what we discussed earlier, right? If it is a bank, the reserve is increasing. Now banks are with 100 million reserves. They can give more loan now. We have discussed already when they have excess reserve. Now this is excess reserve, right? Already they have reserve. Now additionally, they are getting 100 million reserve. Now excess reserve. So they can lend. So people get more money. If the central bank purchase from the bank. If central bank purchase from a public, you could see the currency in circulation is increases. So then public gets more currency now. Clear? So now people will get more money and they can spend more, and the economy may be activated or back in full scale. So in a situation like this, economic crisis situation, every country do the same thing, because like you cannot increase the production overnight, but you can increase the demand. When the demand is increases, definitely the producers try to produce more. Then the economy may be like slowing, again can pick up, right? That is the purpose of this open market operation. With the example, current example, right? You could see so many times in the central bank activities. If you see this monetary policy announcement and central bank activities during this pandemic situation, so many times central bank continuously doing this one. right? This is open market operations, right? So you should be able to understand why this open market operations needed and what is happening to the money supply when the central bank purchased the securities from the bank as well as non-bank. When you say non-bank, you assume like a public, non-bank public. Okay, so is that clear? So then up to now we have seen the purchase. Next we can see the sales. It will be opposite, right? Here reserves and currency in circulations increases, but when they sell, the securities will go to the bank, then reserve will be less. Or if it is a public, so securities will go to the public, the currency in circulation will be reduced. So if central bank thinks, okay, now its economy is overheating, prices are going up, right? So they have to cool down the economy. So they have to reduce the currency in circulation. So they have to reduce the reserves. What they can do, they can sell the securities to banks or general public. So when the central bank sells the securities, banks or general public will get the securities and give the reserves or money back to central bank. So the reserves will come down. So banks cannot make loans like previously. And other way, if it is a non-bank public, so currency in circulation will come down. So then what will happen? You won't have that kind of demand you previously had. So then our price would be stabilized. Okay, this is open market operation. And through open market operation, how we can manipulate the money supply. Okay, up to now, is it clear? I don't want to go beyond this without clearing this one. Otherwise, like again, might be a story, right? You will need some time, grab the basic points out of that. Is it okay? Any question? So normally in a class like this is the area like a lot of people ask so many questions because this is a practical area, like everybody is having so much of doubts on this, but I didn't see so much of questions. Any questions from you all? Maybe understood fully or like nothing is understood, but anyway, I believe you got the idea behind that.